Okay, good afternoon and welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we have a very special guest, Michael Khouw, president of Optimize Advisors and CNBC anchor on Options Action, as many of you know him. And today we have a very special webinar. We want to discuss the current market outlook. I want to get Michael's thoughts a little bit as far as how he views the current market environment. We'll talk a little bit about what his expectations are, perhaps even some sectors that he's specifically looking at. And then what we want to spend some time is really looking at the questions that you guys have with respect to options trading. And thank you so much for those of you that have already submitted questions. We'll try to get to everyone's questions here today. We have about 15 different questions that you guys have submitted ahead of time that we are going to go over, and we will have a Q&A at the end for those of you that may not have had time or were able to submit questions before this here today. So let's go ahead and get started. Before we jump into the current market outlook, just a little bit of housekeeping. Welcome for those of you that are brand new to Options Play. The tool we'll use a little bit during our session here today. If you don't have access already, you can sign up for a free trial here using this link here at the bottom, which I will add to the chat window for those of you that want to sign up for Options Play for a free 30-day trial. Membership is only $50 a month or $500 a year. And for those of you that are brand new, you can get a free 12-step options trading course as part of your free trial so that you can learn more about options trading along with daily trading ideas that we send out. And even for those of you that are subscribers, you can still get access to the free 12-step trading course by just going to that link. So without further ado, let's go ahead and get started here today. We have a lot to cover. Michael Khouw is on the set of Options Action, so he has a limited amount of time, so I want to make sure we get to as many questions as possible. So starting off, we'll talk a little bit about the current market outlook. I'll bring in Michael in a minute to have him discuss what his views are with the overall market. Then we'll go over the questions that those of you have submitted ahead of time. And lastly, we'll wrap this up with some Q&A at the end. We have about an hour and 15 minutes here today, so we'll hopefully try to get to as many questions as possible. So my name is Tony Zhang. I'm the chief strategist here at Options Play. I want to introduce Michael. Thank you so much for taking the time out here today and joining us. We're really excited to have you. And I believe you're actually on the set of Options Action right now, and you're going to shoot a segment after the webinar. Michael and I have worked for quite a few years now, and I want to introduce Michael. Are you there?
I'm here. Yes. Hi.
Thank you so much for taking the time out here this afternoon. Why don't you give the folks here at Options Play just a few minutes and kind of your background with options?
Sure. So I started in the options business in the mid-90s. I began first as a floor-based options trader, a market maker. I had seats at various times on the Philadelphia Stock Exchange, the American Stock Exchange, and the New York Mercantile Exchange. All of those exchanges, those floors where I worked, actually are not open anymore. The industry has evolved. It's more electronic. I think participants like myself had something to do with that. We endeavored to automate and use technology when and wherever possible to improve our own trading performance back in the day. And one thing led to another, and I ended up moving off the floor and onto a desk where we basically oversaw a number of traders on different exchanges trading different products, single stock. So I have experience trading single stock options, index and ETF options, and options on the energy complex. So options on natural gas and crude oil. Sometime after that, I was working also as an equity analyst for a firm in Los Angeles, which has subsequently become a family office. That firm managed at its peak about $5 billion, deep dive fundamental approach, long short equity. And then some contacts of mine from the options business informed me that Cantor Fitzgerald was going to try to endeavor to move from the interdealer options business to the institutional options business. They wanted to start that desk and begin trading. So I ended up running that operation. I was a partner at Cantor Fitzgerald. I was there for about 6 years. And then more recently, I have become much more interested in and been focusing my time and attention on financial technology. And that financial technology includes options play and some other market participants, artificial intelligence, and things like that to help derive systematic approaches to trading options and using options for investment strategies.
Well, thank you so much for that introduction. I think your background, considering the different roles that you've taken at all of these different firms, will really provide a good perspective on the questions that people will ask or that have been submitted, especially the first one I actually think is one of the really good questions from a lot of retail traders. But before we jump into the questions, I just want to do a quick market outlook, a little overview on the current markets. We have a bit of volatility that's crept in over the last few weeks. Trade wars and tariff rhetoric has really pulled back the markets a little bit. Things have not collapsed. Things have not gotten really bad yet. However, we're starting to see some cracks in the market. So I wanted to get a sense for your views from a broader perspective. Number one, do you see this pullback that we're currently seeing as the start of potentially a larger pullback? Or do you see this as kind of a short-term correction that we needed after a 5-month rally for the markets to kind of consolidate a little before we move forward? I want to first get your viewpoints on that.
Yeah, so I think it's interesting. First of all, when we think about the longer-term bull market that we've been in, so if we consider it beginning in, let's call it April of 2009 is when the secular bull market that we've been in really commenced. A large portion of that bull market has been characterized by unusually low volatility. The lowest volatility that we saw actually was in 2017. And that was really unprecedented. It was the first time in my career that I saw S&P volatility, both realized and implied, down in single digits for any persistent period of time. I think I had measured going back to the early 1990s, how many times I'd seen that previously. And I think there were only 6 trading days where we saw the kinds of low implied volatility that persisted for a month or more in 2017. And all of those days when we saw it were typically, for example, right before a holiday. So in the Thanksgiving, Christmas period, typically very low volume and not a lot of activity. So, that was pretty extraordinary. And I actually think that low volatility regime that was one of the characteristics of that bull market ended in 2017. We've had periods of relatively stable markets since then, but many of the people on this call may remember that in February of 2018, that was the first real sharp drawback that we saw from a low vol environment. And while we've had these periods of relative stability since, I don't think we're going to go back to what we saw in 2017 and the years prior. I think we, are in a higher volatility environment. And I'm not just saying that because we happen to be down, 140 basis points today, down almost 200, I think, at one point on the S&P. But the other thing I think investors ought to remember is that really low volatility was not normal. That was not a normal state of affairs. We may have gotten used to it. We may have liked it. But that's not a normal state of affairs. And I don't think we should expect it to return, but I also don't think we should be panicky about that. So 2 other points I would just make about the general state of the market. We have, from a valuation perspective, the S&P is maybe closer to the upper end of the range that I would look for rather than the lower. The reason for this is that, when we, I think right now we're trading about 18.5 times earnings on the S&P. So that's not grossly overvalued. But the thing is that when you look at these valuations, you should consider, do we think that the earnings and price to earnings, that can really grow materially from here? Are there risks to earnings? And here are some examples of some of the risks we could have and some of the benefits and tailwinds that it has had that probably can't recur. So risks, inflation. And inflation doesn't have to come just from, say, rising commodity prices or something like that. Walmart on their earnings call just recently was talking about the fact that they were able to pass on higher prices that they were seeing resulting from trade issues, tariffs, whatever, on to consumers. Well, that causes consumer price inflation. That's not good in general. It's fine for those companies that can pass it on, but only some companies can do that. So staples companies can do that, but other companies cannot. So that could be detrimental if you see rising costs, but you can't necessarily increase your prices at the same rate. It's going to create some haves and have-nots in the business world, and that could, in general, lead to lower multiples. So that's not a positive. We have an upcoming election. There's a lot of pay their fair share kind of rhetoric going on. And if that pay their fair share is about corporate income taxes, we somehow see a reversal, and we start seeing corporate income tax rates go back up again. That obviously, once again, hits earnings. And, if anything, that means that we're probably at, closer to the upper end of the multiple than the lower one. But at the moment, these are fears I have, not realities. So, I'm not saying we should all just run out and bail out on stocks here, but I think we should expect this kind of bumpiness. I also don't necessarily expect a resolution on the China trade war issue really soon, not a comprehensive one anyway. Yeah, so I think we're kind of in this kind of a market, and I think that's also okay. It probably sets up well for things like overrides.
Yeah, so especially what we're seeing, in some of the reports recently from Nordstrom's and Macy's, these retailers have really, had terrible numbers come out.
Tony, I apologize, but for whatever reason, you're quite faint to me. I'm not sure if that's a problem that anybody else is also having, but
Is that any better, Michael?
That is a whole lot better. I wasn't really able to hear you. Now I can.
So like you said, this is exactly what we're kind of seeing as well, is that there's certainly some risks to the markets. And when you say, you don't see a resolution happening anytime soon, I think that's really what we're seeing in the price action today, right? The markets are basically suggesting that the fact that we're not seeing any clear sense for resolution is why the markets are starting to pull back a little. So are there any specific sectors that you are currently looking at? You mentioned that some sectors aren't able to pass on those inflations onto the consumer. So do you see discretionary at a higher risk than staples?
Interestingly, I think, the highest flying sectors, the ones that have benefited from, this environment that we've been in, which is, virtually no inflation. Our technology companies, hardware companies, they might be companies that are going to have a harder time passing those things on. As I mentioned, staples companies probably can pass those things on. Utilities, perhaps. The utilities and staples are not exciting places to play in the market, generally speaking. But they do have an interesting characteristic, and that is that they're kind of these steady Eddie companies that generally get to preserve a margin in a variety of economic conditions. So they are often referred to as bond proxies, but unlike bonds, those types of companies tend not to be as sensitive to inflationary pressures. So you could sort of think of them as an inflation hedged fixed income proxy. A sector I've really been paying attention to lately also because, I think it's really extraordinary what's going on there is energy. I mean, it's just been decimated. You take a look at some of the oil service names, for example, these things are some of the worst performing stocks out there. Some of them, I understand that. Some of them are also very sensitive to potential rising rate environments because a lot of them are levered, have highly levered balance sheets, capital intensive businesses. So I think I'm thinking about kicking the tires a little bit in that space. I actually own Halliburton, which is, I think, probably the best of the oil service-based names to be in. Obviously, the company's very, very hard hit. So I think that's kind of interesting.
Okay. So do you think that energy is going to continue to see some weakness going forward?
I think it's going to be very choppy in here, and today's weakness in oil didn't help. When we take a look at what's going on, we have basically biggest domestic oil production that the country's ever seen. We're the largest oil producer in the world. The Permian Basin is, incredible source of oil. I expect that to continue. So, the near-term supply-demand picture, I expect it to sort of stay right in here. But I also believe that, not all of these businesses are directly hinged to oil per se, but to activity in the oil patch, right? So we can think about, if you're in the E&P space, if those that are actually out there drilling, if oil prices rise, they are levered directly to that. So you're going to see explosive opportunities if oil prices were going to rise. But for as long as you expect there to be a lot of activity, say onshore North American land-based drilling and so on, a lot of the companies that are servicing those businesses, they don't necessarily have to have oil prices get up to 100 plus a barrel for them to make money. It just has to be high enough that the people who contract them continue to do that. And I'm not hearing of any slowdown in that activity. So I think that's, once again, it's a have and a have not story. But as far as those that are servicing the land-based North American oil business, the sands companies also, for example, they obviously are going to continue to see some activity. And I think they've been taken down as a group,
Right.
Somewhat unfairly.
So for those of you that use Options Play, you can use our watch list feature to track the individual sectors. We score the sectors based on relative strength. And as you can see, real estate and utilities are the only two sectors that are positive on a day like today. They are also the strongest sectors. This is really where we are seeing a lot of strength, while energy on the other end of the spectrum is the weakest sector and is also the sector that has taken the biggest dump today. But that was also a lot of because of oil prices and not necessarily changes in fundamentals for those companies. And this tool really allows you to see how these sectors have changed. And we have seen a bit of a crack in technology as the trend quality in technology has really deteriorated over the last couple of weeks, as the 75 resistance level on XLK has really held over the last couple of days. We're seeing some nasty moves to the downside, and there's a lot more risk of the downside, in my opinion, on a sector like technology. So thank you so much, Michael, for that overview on the market. Let's go ahead and jump into some of the questions. I actually really like this first question because I get this, I see this type of question a lot from the retail side. And I really like the fact that you have a market making background to give us a little bit more insight into this. But essentially the question is this, Bruce asked this question, and he basically notices that there are sometimes sudden moves in the bid-ask prices of the stock or the option as he places orders. And he's asking if there's some kind of dark money that's manipulating the stock price, or the brokerage house that's complicit in allowing this dark money to access and see your traders' holdings or manipulate specific orders. And he's asking, is he being paranoid, or is there something going on against the little guy? And what is your perspective from a market maker's?
Yeah, I don't think that there's really something going on against the little guy per se. Nobody's out there saying, okay, well, there's a bunch of retail investors. Hopefully we can pick them off. Most of the big market making firms actually garner much larger bid-ask spreads on larger orders, institutional orders. So to the degree that price really is going to start to matter, that's the place that they're going to be much more sensitive. I'm just talking about the institutions and where they make price. However, what you observe may have some basis, but it isn't, there's no person behind the curtain, no wizard back there who sees your order and says, aha, now I know what I'm going to do. What may happen, and let me give you an example. Let's assume we have an option. Let's say that option is 2 bid at 220. And you think, I want to buy this call option, and so I want to pay a mid-market spread. So I'm going to put in a limit order, and I put a limit order to buy 10 lots and pay 210. And as soon as I do that, what I see is that the new market is now 210 at 220, or 210 at 225, or 230, and there's other people bidding alongside me. Does that happen? And yeah, the answer to that is it does happen. It's not some nefarious actor. It's just algorithms that, there are a lot of algorithms that have price matching features. So in other words, there may be a handful of market participants who are making price, and then you have a whole slew of other market makers who just say, whatever the best bid or offer is, I want to match it. So if it's bid 210, I'll be 210 bid. If it's 2 bid, I'll be 2 bid. Whatever it is, I'll match it. And their idea is that when someone comes in to sell, they will have an opportunity to participate, and then they'll put an offer out and so on. So you will often see algorithmic market makers who are not using quote engines, but instead are using matching engines to make price, tag along with your orders. However, there are people who are looking at vol space. So to the degree that 210 is a reasonable bid, as the price of the underlying stock moves around, you eventually probably will get hit. So I think you probably do see that from time to time, but I don't necessarily think it's nefarious. And the other thing you can do is in situations where the bid-ask spreads are tight, SPY, IWM, Apple, names where you only have a couple of pennies, maybe it's not worth sitting there and trying to wedge yourself in on a 2-cent wide market and put your 10 lot in there and see someone tag along and then wait and hope that you actually get executed at a price. I mean, that 1 penny is $1 per contract. On a 10 lot, that's $10. But you're going to control 1,000 shares. Does it really matter? Probably not. And on the wider spreads, you do want to use limit orders, and you just, having other people tag along and say, oh, you'll buy there, I'll buy there too. That's okay. That's just, that's a part of it.
So what you're basically saying is that market makers are not there trying to pick off your orders or take advantage of the little guys. If anything, they might be, it's much more so on the institutional side when people are trading much larger size. Is that maybe potentially the concern?
Yeah, no, and what I'm saying is that just when you see things happen, and there are people on this call who I know have done this. They put an order in, they've seen their price show up on the screens, they didn't get a fill, and they also noticed that volume built on their price. And then if they pull their order back, they said, well, I'm not going to bother to do this. They saw it all go away. That does happen, but it's not nefarious actors. It's just that there's two kinds of market making algorithms for making price. One is typically based on vol. I think it's a certain theoretical value, and they make a bid below that and an offer above it. And the others are the tag-along types of market-making algorithms, and they typically just try to participate on the best bid or offer so that they get some piece of the action when the other flow comes in. So they're not really focusing on whether it's a customer or anything else.
Right. Understood. Thank you so much for your insight on that. Let's move on to the next one. The next one is Emil. Emil is talking about a specific trade. I think this was highlighted on Options Action. I know not everyone traded this, so let's not spend too much time, but he traded the Yeti calendar recently. It did work, but now he has an August call losing theta. Do you hold on to this call, or do you consider getting out once the short leg of that calendar has expired?
Yeah, so one of the things I articulated about this trade, this is an important teaching moment, I think, just in general. I love calendar spreads. One of the reasons is because when you're long a longer dated option, sell a shorter dated one against it, the theta of that shorter dated option is greater. So this is a positive carry trade. So if the underlying stock doesn't move around much, you're actually getting paid to be in this position, and you're managing your risk because you own one option and you're short another. In these situations where you sell a short dated option, let's say it was an April option, or maybe in this case it was a May option against August, usually what I like to do is as soon as my shorter dated option expires, assuming that I'm still comfortable with the position, I then turn around and sell the next one. So if I was short May, now I would sell June. So now I'm in the June-August call calendar, and then I'm collecting theta once again. The only time that you would allow the long option to ride without doing that is if the only reason you're in the calendar in the first place was because you were trying to own the longer dated option for a longer dated catalyst, and now you think so you're trying to mute that impact of theta in the short term, and now you actually want to own it. So maybe you think earnings are coming up and you're bullish, but in general, if your strategy is a calendar, when the short leg rolls off, either take the whole trade off, so that means sell your long dated one, or sell another short dated option against it so that you're back in that calendar trade.
Great. I think, like you said, that is a teaching moment for any type of calendar, or even if you're long a leap. Once you have that short leg expire, think about selling another one. Very similar to the concept that you would do with a cover call. Same concept here when you're trading calendars. So
exactly.
thank you so much on your perspective there. This is a great question because, we feature options action trades every single morning. Frederick is asking, on options play, we talk about the previous Friday's options action trade. How do you actually stay on top of these specific trades and finding profit and loss information on options action trades?
Yeah, so this is something, if you actually put the trade on, and you happen to be a user of options play. So I'm going to use options play as an example here because I think they have a very good way of monitoring it. You can add that to your portfolio of options trades and you'll receive alerts, because it's true, trades get talked about on CNBC all day, every day. I mean, on any given day, there's probably 15 traders who are on, plus a number of other analysts and portfolio managers. If you started watching at 6 in the morning and you watch it until after Mad Money ends at 7 p.m., the number of trades you're going to have seen is countless. The number of updates you're going to get on those is very limited because each day they're talking about whatever is newsworthy on that particular day. So you unfortunately, as the viewer, it's going to be incumbent on you, if you decide to follow along with something that you've seen or heard, you're going to have to monitor that. So you need a tool to do it. Tony can probably speak to it, but one of the nice things is that in options play, if you put that trade on and, for whatever reason it makes sense to take it off, there's usually an alert that can be set up. So, it's oftentimes based on how much you spent for the trade initially. We do try to provide updates periodically on the show, but, the show is 30 minutes long, some advertising, some taped pieces. We only actually talk for about 16 to 18 minutes during any given show, and there's 4 of us. So that means we're going to talk for 4 minutes. It's not hard to believe, but in a 30-minute show, I'll probably only talk for 4 minutes. So you guys are going to hear me talk a lot more now than I do in a month on the air. So, we're not just simply not going to be able to get back to every trade. We do sometimes also tweet out updates. So I encourage, and this isn't just about me or Options Action or Dan Nathan or anything like that, but if you are watching the stuff on CNBC, a lot of the people also are on Twitter, and in many cases they'll update their trades that way in real time, because also our shows after hours doesn't really help you if at Friday I say, oh gee, you need to just sell that option today, market's already closed. So using a tool like Options Play or following us on Twitter is probably a better way to do that.
So for those of you that are subscribers to Options Play, all of the trades that we highlight on Options Action, we put into the portfolio, which you have access to, and you will see alerts on specific trades when they've hit a stop loss or if they've hit a take profit. You get those alerts on your screens, such as the Home Depot trade that was from last week. We have that put vertical here. As you can see, currently that trade is down 8%. And also for those of you that have attended some of our webinars, we talk a lot about what are the rules to consider when it's time to take some of these trades off, whether it's to take profit or cut your losses. But those rules are built into our Options Play tool. So please follow along to our portfolio tool for those of you that want to track some of these options action trades, including our daily play trades. Let's move on to the next one. Mitch is asking, how do I sign up for the free trial for the credit spread service? Mitch, what I'll do is I'll send a link in the chat window for you to have access to our credit spread trading service. You can access it through that link and sign up for a free trial there. Let's move on to the next one. Commodore is asking, if we're in a range-bound environment, do you recommend using butterflies or iron condors? It's a good idea to combine them using different expirations. So, Michael, before I pass this on to you, I'll just give my 2 cents on this particular trade. If you think about butterflies and iron condors, that's really just a combination of credit spreads combined together into a call side and a put side, and the call side being mildly bearish and neutral, and the put side being mildly bullish and neutral. And the butterfly is really just combining the two. And if you think about when you put on a call credit spread versus a put credit spread, I'm rarely in a situation where I'd want to put on both at the same time because I'm either mildly bullish or mildly bearish. I'm rarely both. So my views are that if I'm going to ever trade a butterfly or a condor, I end up legging into them where maybe the stock's oversold today, so I'll put on a put credit spread. And perhaps a few days later, it's jumped higher and it's now overbought. And that's when I might initiate that call credit spread. And combined, that might end up in an iron condor, but I rarely put on an iron condor on its own. So that's my 2 cents, and I'm curious to see what your thoughts are on that, Michael.
Yeah, so I virtually never sell. So I play a lot in the index space, and I virtually never sell credit put spreads in index. I do sell premium in index, but that's not usually the way I do it. There's a couple reasons for this. One of them I think I already articulated when I was just giving my general market view, which is, I think, the kind of bumpiness we saw today, we're likely to see it again. The market tends to move down more quickly than it moves up. People will often say, you take the stairs up and the elevator down, or the escalator up and the elevator down. The market can decline more quickly. That's one reason, but there's another one, and anybody who's put credit spreads has probably observed this. You often will see, due to skew, which is the tendency for farther out of the money put options to have higher implied volatilities, that you might say, look at selling a put spread, and you'll see a $5 put spread in SPY, and the only amount that you can collect for that is $1.25, $1.25, or we're talking about 25% of the difference between the strikes, which means essentially that in that instance, you're risking you're risking 3 to potentially make 1. On call spreads, that skewness works the other way. So it's more common to see call spreads that you can sell in the 30 to even sometimes 40% of the distance between the strikes. So that math just works out a little bit better. The one counterpoint that some people who do these strategies will often say is, I want to be long stocks, so I'm trying to take a bullish view anyway. If I sell a condor, let's say I sell a 25% put spread, and I sell a call spread at 35%, net, I'm collecting 60% of the distance between both the put strikes and the call strikes, and the underlying can only be higher or it can only be lower. It can't be both at expiration if I'm using the same expiry. And that improves the look of that. So I do know some people who are interested in selling put spreads for that reason, but I don't generally use iron condors or butterflies in that context. I have been known to sell further out of the money puts in index land when I think they're pricey, to buy an at the money call and then sell an out of the money call at 0 cost. So using call spread risk reversals in index land when I think it sets up fairly nicely. That way, if it sits right here and does nothing, I don't lose anything. If it drops a little bit, I'm not going to lose anything. If it rallies, I have an opportunity to participate. And worst case, the bottom falls out and I end up owning the underlying at a lower price. If I wanted to be bullish in the first place, that's not the worst outcome. So you can sort of think about it this way: 3 things can happen. 2 of them are good, and 1 of them is less bad.
Okay, thank you so much for your views on that. Let's move on before we run out of time here. The next one actually is a pretty involved question, and this is something that I think some people have questions about, and I think this is something that it's difficult to cover entirely because we could probably have a whole webinar just on this. But Serge is asking, can you explain in some type of detail how implied volatility is calculated for option prices?
Yeah, so I can understand why you want the answer to that question, because we talk about implied vol versus realized vol all the time as options traders. The answer to this is, well, first of all, we don't guess implied volatility. You either have it reported to you by a source that you trust, or you have to calculate it yourself. The way you calculate it yourself is you have to use either a Black-Scholes formula or its functional equivalent, and you have to solve for it with all of the other knowns: time to expiration, the strike, the underlying price, the dividends, and all that other kind of stuff. Because that's usually hard for people to do, I'm going to ignore that, but I'm going to suggest that if it's something you want to learn more about, it's covered in a lot of books. I think actually we talk a little bit about those formulas in our book, but there's plenty of good ones on that topic. Usually your brokerage platform or some other is going to actually give you the opportunity to see what the implied volatility of an option is. And the important thing to remember about implied vol also is, in a vacuum, it's an abstract and arbitrary number. You really need to be able to have a history of implied volatility to see how it stacks up. Are these options more expensive than they typically are in implied vol terms, or are they less? Are they higher than the stock has actually been realizing, or are they less? And also, do we expect it to change dramatically? Here's an example. Most stocks, especially retail stock, for example, are highly cyclical. They're cyclical around earnings. So the volatility of the options and the stock between earnings seasons are fairly muted. And then when earnings comes along, both the price of the options goes up sharply and the volatility of the stock goes up sharply. And we know why that is. I mean, take a look at what happened to Nordstrom. They just reported earnings. The stock got hit 9% right after they reported. You're going to see that kind of thing. So, you really need, when you think about implied volatility, just make sure you're thinking about the context of it. How does it stack up to the way it normally does? And is there something going on now that's different than what was going on a week ago or a month ago? Now, of course, all of these publicly traded companies should be reporting earnings about every 90 days. So chances are, if you can chart it on your application, your brokerage application, whichever one that is, you're going to see that. It's going to be really pronounced. You're going to see it trucking along at a relatively level rate. Then you'll see volatility spike. Then you'll see it come back in and do the same thing. And it, in some names, like Foot Locker is a good example. You look at the last 8 quarters, and it's like clockwork, how volatility behaves. And that'll give you some insight into which options you want to buy and sell and at what price.
Okay, great. And actually, Serge had one other question, which he had so many, I didn't have time to put it on all the slides. But one question that I actually would like to address was, do you have certain parameters that you look for when you sell a covered call? Is there anything specific in terms of expirations or deltas that you use for picking covered calls, and anything that you use to determine whether you're getting enough income on a covered call?
Yeah, so that's a great question. So here's the unfortunate part. It will vary a little bit because some stocks are more levered. They have more levered balance sheets. They move around more. So I expect to get paid more. In general, I don't sell options for less than 1% of the underlying. That's just, we call that, picking up nickels and dimes in front of an oncoming train. I'm just not that interested in selling really cheap options in terms of their relative price to the underlying. So if I can collect, maybe 1% of the underlying stock price over the course of 30 days and decay, that's a very attractive rate of return for me. Bear in mind that with equities over the long run, what are you hoping to get annualized? Maybe 7, 8, 9% a year. I realize that this bull market has people's expectations set a little bit higher, but I think those are, in the long run, reasonable rates of return to expect from equities. When you sell calls against your equities, you're muting the potential upside, but you still are taking equity risk, so you still expect to make relatively comparable rates of return. So definitely make sure that you're doing that. One thing I will also say is that I typically don't sell call options that expire much more than 90 days. You get into a point where the rates of decay of those options is not so great. Sometimes I've definitely seen, even institutions will do this. They'll say, oh, gee, I can collect 3 or 4% of the stock price if I sell that option. Well, yeah, but if it expires 6, 7 months, a lot can happen there in 6 or 7 months. Actually, we have a chart here of Home Depot. Let's just take a look at the prices where this thing has been. In late March, early April, this was a $180 stock, and it was 207 or $8. Only 6 weeks later, that's a pretty sharp move. I mean, we're more than a 10% move. So, you have to think about this. If you had sold a 2.5% out of the money call on Home Depot at its trough, you would have maybe collected 1%. You would have foregone, so you would have made 3.5% over a period when the stock made 10. Now, if you do this, month after month after month, sometimes you're going to win, sometimes you're going to lose. On balance, because there's something called a volatility risk premium, you expect to make money, but you have to be willing to stomach that. The other thing is that I'm less likely to sell call options after we've had a sharp sell-off that I think might be overdone. So for those of you who might look at, say, RSIs or whatever mechanism you happen to use to decide whether something's oversold or overbought, if something's overbought, you're not going to see me selling any puts. And if something's oversold, you won't see me selling any calls. Also, I don't like to sell strikes of options that are way below what I think a stock is worth. There are instances. There was a few years ago, CBR Energy stock was trading at 3-4 times cash flow. I thought the company was worth 3 times, 4 times as much as it was currently trading at. I wasn't going to do any overwrites in that thing, because this was a stock that I thought if the street just came around and saw it my way, it could go from 20 to 60. And how unhappy would I be if I thought I thought a stock was 60, I bought it at 20, and I sold a 22.5 call on it? Wouldn't make any sense. I was in that to make big money, not to make a couple percent. So that's, obviously it's tough to. I'd like to give you a concrete answer. This is what you do every time, all the time, but it doesn't really work like that, unfortunately.
Right, and our research really shows that it doesn't make sense to, or when you're selling cover calls, because the largest risk that you have is actually with the underlying stock. It always makes sense to sell calls that are relatively further out of the money, even if you have to go a little further out in time to get enough premium, but going further out of the money, because you don't want to cap the gains of your stock just to collect a couple of bucks on a cover call. So that's what our research shows. So great. Let's move on to the next question here. Jerry has a good question. When are collars applicable in trading options?
Yeah, so it's funny because collar, if you have long stock position and you buy an out of the money put to protect it and sell an out of money call to help finance the purchase of that put, you end up with a payout profile that looks a heck of a lot like an in the money call spread. You see over here that he's got right there, you see that 190-205 call vertical. If we adjusted those strikes in one panel, if you could, Tony, put we've got the stock at 192, put a 180-200 collar in one, say in July, and then in the other, just put an in the money 180-200 call spread of the same expiration, and then take a look at what that looks like. And you're going to see that that's essentially the structure you're creating. All right, why do I point this out? The reason I point it out is because I hear people talk about collaring positions, one up, sell one call, buy one put. That's not a strategy I'm really all that jazzed about most of the time, unless you, for whatever reason, are in a position where you can't sell the underlying shares. Most people don't have those kinds of restrictions. So that isn't really applicable. Okay, so you see that payout profile, how similar it is between those two trades. It's essentially, you end up with, that situation where you have more risk to the downside than you have potential gains on the upside. Not real crazy about that. I do sometimes like put spread collars though, where I buy a downside put spread and sell the upside calls. The reason I like that is because usually it's not, if you own a stock and you don't have an intention of selling it, your concern and what you're trying to insure against is not a disaster. It's not that Home Depot is going to go to 100 from 192. If you thought it might go to 100 from 192, you wouldn't own it in the first place. What you're really concerned about is you're like, we have a pretty volatile period here. The S&P moved 2% today. Could this thing drop back down to those 180 levels? Yeah, that seems realistic. Could that happen within the next 90 days? Yeah, so that's usually what people are trying to insure against, but they want to have a little bit of upside. So then you would do something like buy a 190-80 put spread and then sell an upside call to help finance that. And, that way you get sort of near-term protection, not disaster protection, but some near-term protection, and you don't have to pay a lot of decay for it. So I don't advocate collars very often. There is another issue too, which is that in some cases, if you have a long-term holding, depending on how you set it up, and this is not to constitute tax advice by any means, but we have situations where it's possible that it can shorten the holding period. So if you have a long-term gain in a stock and you start putting on puts or selling deep calls, for example, on it, you can actually trigger a tax consequence. You won't actually get a tax on it right away, but it could actually reset the holding period and turn a long-term gain into a short-term one. It's not something we like. So, I don't use collars that often, but we do talk about them on the show sometimes because, we sometimes will see institutions do these. Institutions tend to do them because they have liquidity problems. If you have 1 million shares, it's very hard to sell 1 million shares of stock. in anything. You often can get 5,000 collars off though a lot more easily, because it's really the deltas of that trade that the street has to contend with. So it's really something I see more often in an institutional context than a retail one.
Okay, so just to break down what you said, first of all, on the collars piece, you're basically saying that if you look at the risk profile of a call spread versus a collar, they are virtually identical. At effect, instead of costing you $19,000 to purchase this Home Depot collar, it only costs you $1,300. That's your first point, correct?
Mm-hmm.
Your second point, I believe you were saying, is a call risk reversal, where you're buying that call spread but selling a downside put. Is that what you're referring to?
Yeah, so that's another trade you can do. So I like call spread risk reversals as a bullish bet. I like put spread collars where I don't buy an outright put, but I might trade put spreads. And now again, I said earlier, I don't like selling put spreads. So if I don't like selling put spreads, then I'm obviously going to be a better buyer of them, generally speaking. And because of that skew, I like to sell out of the money puts when I can, especially when, sometimes you'll do this into events. Those out of the money options that you would be selling. So I might buy, 190 put and then sell some 180s or 175s against it. Those things can really get elevated. That was actually kind of the thesis going into earnings a little bit here on Home Depot. Home Depot, as it turns out, and we can see in this chart, actually on a week for many names in retail, actually seemed to hold up a little bit. Lowe's, I think, had some more disappointment. I'm not exactly sure what's trading right now because I haven't had a chance to look, but they weren't really overwhelmingly positive after they reported. So Depot reported first, then Lowe the next day. That's hopefully that's helpful. But I prefer to be a buyer of put spreads when it's appropriate. I rarely sell them. I don't trade collars on long stock positions virtually ever. I just do that. Sometimes for institutions, we'll advise it because it's easier for them to hedge a portion of what they have than buy and sell massive blocks of stock.
Well, thank you so much for your insight on that one. Next question from Mark. What's the best way to keep trade logs? Any software for analyzing potential or current trades? So Mark, one of the best ways that you can actually do this is Options Play does have a portfolio tool for users that are subscribers. So if you're interested in learning more about that, you can send us an email at info@optionsplay.com, which I just put into the chat window, and we can set you up depending on your brokerage firm on that specific tool if you have a subscription here with us. So that's how you can utilize Options Play. Michael, I don't know if you have any other software that you'd like to talk about.
Yeah, well, I do a lot of, we have access to a couple different things. I use a lot of different applications. A lot of times when I'm just trying to do modeling for stocks and thinking about levels where I want to get into stocks, out of them, fundamental levels, things like that, or just trying to measure and get some statistics on changes in volatility, I use Excel for a lot of that. I think Options Play is a very handy feature because it's, I have data feeds that go into Excel and because of those APIs, if I put a trade in, I can track it in there and I can sort of build it in its own customized way. But I think something like what Options Play has, if your broker doesn't have something, most brokerage platforms these days, they've gotten much, much better. So not knowing which one you use, I can't really speak to that specifically, but you can sometimes put simulated trades in. Obviously, they usually have good mechanisms for monitoring your live trades. And when you're not doing that, I like using things like Options Play. The nice thing about Options Play also for that is that you can quickly compare different ideas. So you saw what we just did there, where we looked at a collared stock versus an in-the-money call spread. You can do that kind of side by side. Just quickly change the strikes, the expirations, the quantities, ratios, whatever it is you want, and look at them all and say, I like this one better than that. And of course, they have their own scoring mechanism. But you can see the probability of profit, where it breaks even, how much you're spending, worst case loss. Those are all the things that you usually want to be able to think about. And if you can see them side by side, and then if you decide to trade it goes into the portfolio function, you can monitor it in there. I think that's pretty handy.
Well, thank you so much for that. Let's move on to the next one. I think this is a really good question for those of you that like to buy longer dated options. I think if you want to participate in the markets at the current levels, I think buying long dated calls makes more sense than buying the underlying stock. So James is asking, what deltas do you recommend when buying a longer dated option?
Yeah, this is a really good question, and this is going to be a place where I disagree with Jim Cramer. Jim Cramer has written about this, and he's talked about it too. He has talked about buying long dated options. That's great. Rather buy long dated options than short. The decay is much lower, so that is definitely more in your favor. You're giving yourself a lot more time for your thesis to play out. He likes to buy them deep in the money. So those would be high delta options. In his case, he's probably talking about 70 deltas or more. That is not the way I do it, and there's a couple of reasons for that. But the biggest reason is that if you are long options, what you are trying to get the benefit of convexity. What I mean by that is a stock is linear. If it goes up 10%, you make 10%. If it goes down 10, you lose 10%. If you own a call option on a like amount of shares and it goes up 10%, you will make more than you will lose if it goes down 10. That's the convexity. Make more, lose less. That's the whole idea. The price you pay for that is decay. So, I would probably, as you go further out in time, the tricky thing about saying delta is that as you go further out in time, a more and more out of the money option will have a like amount of delta to a shorter dated option that's closer to the money. So I usually like to think about it in moneyness. What's my thesis for the stock? Do I have a price target that's 20% higher? Well, if that's true, I probably want to own a call option that's, maybe somewhere between 3 and 5% out of the money. And this is actually the counterpoint to the thing that Tony was talking about earlier. The probability of profit goes down as you push that option further and further out of the money. So I'm looking for a balance between the convexity that options offer, that nonlinear payoff, but also I want a probability of profit. So I'm usually looking, when I buy calls, and actually anybody who watches the show knows this, we're buying calls on stocks. We typically are staying pretty close to at the money or just out of the money if we're looking for a little extra gearing. But you're not looking for moonshots typically because they don't pay off very often.
Well, I really appreciate your views on this because I happen to agree with Jim Cramer on this one, but I actually think it comes down to the difference in terms of what your expectations are. Because the reason that I think, at least I look at deep in the money calls. So I have Home Depot up here. 100 shares of it cost me 19,250, 19 grand. Buying a deep in the money January 2020 165 call, which is roughly about a 80 delta here, 75 delta, will cost me $3,000. And your at the money call, which I believe you prefer at the money calls for these,
at or slightly out, but yeah.
$1,300, right? So 3,000 would be roughly a little over 15% of the underlying, and versus yours is a little under 7 to 8% of the underlying or so, right? And I think the reason that I prefer using these deep in the money calls is because what it does is it mimics the stock price. As opposed to what you're looking for is really that convexity, right? So where as opposed to I'm not looking for convexity, I want symmetrical exposure at a fraction of the cost. It's really giving me the same.
Yeah. So you actually, your trade is essentially the equivalent of owning the stock and having a way out of the money put on it, exactly. Right? So you're owning stock with disaster protection when you buy that in the money put, and that's fine. I would make a slightly different point, which is that if you have a portfolio of stocks, you're kind of counting on dispersion to help you out. What do I mean by this? Let's say I have calls on 30 stocks. Now, correlation has been very high lately, so it seems like all stocks go up, they all go down. But in normal market environments, that's not necessarily true. Some go up, some go down. If I owned at the money calls on a basket and maybe half of them stayed put or didn't move very much, so that's 15 stocks, 5 got crushed and 5 knocked it out of the park, and then I had a handful of others that did something in the middle. The long call options that I own would have done very well. The ones that got crushed, I wouldn't have lost that much, and then I facing decay, which I can contend with in other ways. By the way, that's another important point. If you have that deep call option that you're talking about, or even the at the money one that I'm talking about, you can sell calls against that to help mitigate some of that decay. This 190 call that you're pointing out is in the money. I want to make one very quick point here, which is that I do not typically buy in the money calls on stocks that pay high dividends. The reason for this is that there are circumstances where economically it makes sense to either sell your call option before a stock goes ex-div, or if you really wanted to own the stock, to exercise your option to collect the dividend. So for people who are on this call that don't want to deal with that complexity, if you have a really high dividend paying stock, stick to out of the money call options if you're making a directional bet. Don't get caught up in that. Another quick point too is that if you're short call options against stock you own, so I have a high dividend paying stock, I sell covered calls against it, and I kind of let the stock get away and my calls are now deep in the money. Pay attention to those ex-dividend dates. It may make sense for you to consider covering and rolling those options before that, because you may find yourself getting called out, because what ends up happening is that the net present value of the dividend might actually exceed the optionality value, the extrinsic value of that option. And when that happens, that's the only time really on call options it makes much sense to exercise them prior to their expiration date. So that's just kind of a little warning there for people who are thinking about it. You don't want to tangle with really deep in the money call options on dividend paying stocks.
Absolutely. Great information. These are some of the things that we cover on our webinars for buying leaps and selling calls against those leaps, or what we call a poor man's cover call. Also, how to manage those those short call positions as you near expiration, especially on higher dividend paying stocks. So for those of you that want to learn more, please take the time out to look at some of our webinar recordings that we cover some of these. So last question here. This was a question regarding a Twitter long call. I think this is a really good question, because I find a lot of users that are buying calls may find themselves in similar positions. So this person has a June 1st weekly expiration 40 strike call at 25 cents, which I believe is currently trading around 33 cents or so. Let me just pull this up right now. And his question was, I had the chance to get out yesterday with positive net, but I didn't. What's your thoughts on in terms of reducing the risk on this position or potentially adding to this position? And I'll just bring it up real quick before you have to comment here. The first weekly June 40 calls are trading at 33 cents. He bought them at 25 cents. He's asking, what do you think he should do here on one of these out of the money calls?
Yeah, so kind of interesting, that you pointed out that yesterday, the stock was considerably higher. It traded over $39 yesterday, so that call was obviously a great deal higher too. So you were probably looking and feeling pretty good. I'm just going to console you a little bit here and say that I probably wouldn't have done anything to that option yesterday had I held it. The reason I wouldn't have done anything is because when I use calls to make bullish bets, I don't usually look to roll or adjust them until they start trading in the money. So in this case, because it's a 40 strike, had it traded up to 41 or 2, I often look to roll, because I'm trying to preserve a bit of that convexity. When they get deep in the money, they start behaving more like stock. That's not the reason I bought an option in the first place. If I wanted stock, I'd buy stock. It's pretty straightforward. So I wouldn't feel bad about the fact that you had there's no trader on earth that didn't have countless numbers of times that positions could have been sold at better prices with the benefit of hindsight. So don't sweat that one. Add to the position. Well, that is really going to be your particular call on Twitter. I don't personally have a position in Twitter. I'm not overwhelmingly bullish on the stock personally, so I'm not trying to dissuade you from your position, but I'm not bullish on the stock, so obviously I wouldn't be buying calls. One thing I will say is that you could consider, one of the things you have to think about is my thesis that we have upcoming news and I think the stock could gap higher. That's when an option like the one you own is really good. If you think it's going to drift higher, I would rather own longer dated options and then sell out of the money calls against it to help finance that purchase. That's just typically the way I would play it. Let's see, do they have any upcoming catalysts? We can take a quick peek as far as Twitter is concerned. So they're not going to be reporting until the 26th of July. They reported on the 23rd. Obviously, the stock moved up a lot on that. Let's see if they have any other catalysts here. One second. Let's see. We have that Wedbush conference is over. So Michael Pachter, I guess, he covers this name among others. He's a Wedbush analyst, pretty well known and well, covered media and so on. He's doing a digital media event on the 29th. Yeah, so there's not a lot of catalysts between now and July. So I'm not exactly sure what would cause it to gap higher. My preference, if I was going to take a bullish bet, would be to own a longer dated call, sell some shorter dated ones against it. If it was going to be the 40s, you could sell these options and then just recurrently go ahead and sell calls against it. That would be my approach, because I don't really see that catalyst is going to gap the thing higher before we get to the next earnings. It's my 2 cents, or 33 cents. I guess that's what those calls are costing right now.
Yeah. Well, thank you so much for your time here today, Michael. We've gone through all the questions that people have submitted earlier. We are now at the 1 hour mark. Are you short on time, or do you have a few minutes?
Well, I'm in the studio. I think my camera window opens at 1:30, and they might want to put a little powder on me so I don't reflect the lights that are in the studio back and look all shiny. So that doesn't usually take too much time. But I have a couple of minutes. If people want to ask some questions, I can probably stretch this for another 7 to 10 minutes.
Great. So you tell us when you have to jump. Thank you so much for taking your time out here today. Looks like we have a couple of questions here already. If you have time to answer them, please do. If not, please let us know if you have to jump.
Sure, I'll do my best.
So far, it seems like the overall consensus is everyone loves this type of format, very informative, very interactive. Wayne asks, sometimes when I place options orders, it is not accepted because it's not trading in pennies. Who determines which options can trade in pennies? Individual brokers? And how do I see which options trade in pennies? And I can answer that, Wayne. It's not the brokerage firms that control that. It's the listing exchanges that control that. And there are names that you can actually search online as far as which ones trade in pennies. And there are rules between whether it trades below or above $3, I believe, if I'm not mistaken, that determines whether an option trades in pennies or not.
Yeah, so I'm just going to quickly chime in on something here. So there actually are technical challenges to having options trade in pennies, and it has to do with quote traffic. So if you can imagine how many individual options there are on a given stock, and the prices of those options, especially if they trade in pennies, will change every time the price of the underlying changes. So all of a sudden you end up generating massive amounts of quote traffic, and it's hard to believe, but at a certain point, all of those quotes, millions and millions of quotes per day, especially in options that don't trade that often, is actually a real challenge for the exchanges, for the market makers, and everybody else. It's a big expense, and you need massive pipes essentially to be able to push that. So they generally will tend, it's going to be based on volume. It's going to be based partially on price, as Tony was referring to. But again, a nickel, 5 cents on an option, that's 5 cents a share. That's going to take place on names where, they don't trade quite as much volume as, say, SPY does or Apple.
Okay, thanks. And Ed is asking, what are your thoughts about expirations other than the monthly expirations?
Yeah, so I'm agnostic personally. I like the fact that there are more expirations. Weekly options, especially the sale of weekly options, are, I think, a great thing, because actually, when weekly options first came out, especially before Apple was a pre-split stock, a lot of people found it was just too capital intensive to make directional bets, buying and selling the stock. So what they would do is they would use options to basically reduce their capital requirements to do that. A lot of them were using weekly options, thinking, I guess, that they, buying little lottery tickets. A lot of those options were overpriced. I know at least one dealer, and he told me that all of the profits that his group made in a single year as an options market maker, 60% came from being a net seller of weekly options in Apple for the whole year. So I think you should use weeklies. If you're going to buy them, do so very sparingly, because you really need something to happen. That's the hard part that people need to remember about buying short-dated options. You need something to happen for that to be profitable. Otherwise, you lose your money. And the chances of something specific happening are almost always lower than nothing happening, or maybe it goes in the opposite direction. So the probability of profit tends to be low. So in general, I prefer to be longer dated options, but I love the fact that there's just more expirations, and I don't think you should steer away from one or the other, especially when you've got catalysts. You can really tailor those dates nicely in ways that wasn't previously possible to do.
Yeah, I mean, weekly options have really expanded our ability to get very exact when we're selling options. So whether you're selling covered calls, selling cash secured puts, or even credit spreads, weekly options have really allowed us to get really finite and find the exact strikes and exact dates that we're looking for. So from a trading perspective, there's really no difference between a weekly and monthly option. And I tend to find you have a lot more strikes on the weekly options. So for selling options, it is a great tool. Looks like we have one last question, Michael. Do you trade differently when market movement is largely news-driven versus economic-driven market? Not sure what he means by that question.
Well, the news that usually drives stocks has some economic basis. Usually, doesn't really matter, right? So let's think about the kinds of news that drive equity prices. Rates. But that's an economic question, right? So there's really two rates that drive it. There's the actual rates, and then people's concern about what the Fed will do. I think if you want to know what the Fed will do, just look at 1-year treasuries. I mean, people masterminding the notes that the Fed puts out. If you actually take a look at the past 25 years of Fed rate activity and policy, it pretty much mirrors what the 1-year futures were showing. So, you can read those letters if you want to, try to tease out little differences and nuances in the language, or you can just look at the futures, and that'll tell you what the market thinks. It's pretty good indicator. So in short, do I trade differently? I do trade differently particularly when I think there's a washout. There are circumstances where I just feel like when everybody's looking down, it's time to look up. You can really see, Mark Haynes, actually, he's the one that famously called the bottom in the equity markets on CNBC. And I think what he's a news guy. So he was getting news from every possible source, and every single source he had said the world was coming to an end. And that was actually when he said, you know what? No. The world's not coming to an end. And if everybody thinks it's going down, that means there's not a buyer in sight. It only takes one to level things off. It takes two to get the prices to stabilize a little bit, 4 or 5, and suddenly the market's going to start turning around. So, I think we're better off in terms of finding opportunity when we have a news-driven market. But I'm trying to remember a time it wasn't somewhat news-driven. 2017, I guess. 2017, it seemed like nothing would touch it. But if the markets are, as I believe they are, in a more normal condition, which means we will see the VIX hit 20 from time to time, and 14, 15 realized vol is a normal place to be for equities, maybe a little bit higher. We're going to get more opportunities than we have had.
Well, Michael, I just want to thank you for taking the time out here this afternoon. I think this is very informative, not only for myself, but hopefully for everyone here on this webinar. I want to make sure that you have enough time to get on your show. Do you have any last words that you want to speak to everyone?
No, I appreciate the invitation. My wife will say there are few sounds sweeter to me than that of my own voice. So these are things I'm interested in, and I love to talk about them. And I look forward to the next opportunity.
Yeah, thank you so much, Michael. Good luck on air, and we'll see you soon.
All right. Thanks for having me.
Have a good one. And everyone, I'll see you guys next week, next Thursday. thank you so much for taking the time out here this afternoon. We'll send out the recording in a few minutes. Have a good evening, and I'll see you next week.